Welcome to the United Traders lesson on risk management. In this introductory lesson, we will go over the main concepts of risk management, some basic definitions, and explain why risk management is pinnacle to the success of any person interested in the financial markets. We will be going over topics such as diversification, stop losses, expected returns, position sizing, and averaging down. Before we begin, I'd like to give a huge shout out to everybody involved on this project in United Traders. This lesson was made through the hard work of many like-minded individuals looking to help the community members become financially free. What is the primary goal of being a participant in the market? Almost everyone who is involved in the financial markets has the same goal: to make money. Of course, we would all like to maximize our profits and minimize our losses. To do this, we must not only calculate what returns we should expect from any trade or investment, but also to identify, analyze, and mitigate or minimize any downside risk that is possible within our strategy. Successful traders have two traits that make them stand out from ordinary investors. They are able to significantly beat market benchmarks like the S&P 500 while minimizing account drawdowns. In other words, they are able to achieve alpha while reducing beta. What is risk management? Simply put, risk is the possibility of losses in the financial markets. As Investopedia puts it, risk management is the process of identification, analysis, and acceptance or mitigation of uncertainty in investment decisions. How is risk measured? There are many ways to measure risk, and none are the be-all end-all. One of the many ways institutions and investors measure risk is value at risk. Value at risk, or VAR, measures the statistical drawdown that can occur within a band of confidence within a specified time range. For example, this chart shows that the sum of days with a portfolio drawdown of 47 million or more total approximately 5% of the total days considered in the sample. To mitigate risk, you must understand where to look. Some of the most fundamental sources of risk include market risk to the broad market. This will affect most sectors of the market simultaneously. Possible sources of this risk may be interest rate changes, significant commodity price changes, inflation, geopolitical events, recessions, and currency exchange rates. Alpha risk, or the risk of stocks that are specific to those companies and/or sectors. As an example, the alpha risk on Netflix might be embodied as a competitor releasing a new product that decreases Netflix's market share. Beta risk, the effect of market risk on specific stocks in a portfolio. For example, high-risk stocks have a much higher beta than low-risk stocks, and accordingly fluctuate much more dramatically with market shifts. Correlation risk, the idea that many things in the market move together. For example, if the S&P 500 is moving down during market hours, it is very likely that individual positions within the S&P 500 will move similarly. Strategies for risk management. Diversification. Investing in or trading multiple different market sectors that are not heavily correlated to the same risk factors. For example, avoiding a portfolio comprised mostly of highly speculative, unprofitable growth stocks, which are highly inversely correlated to a retail trader, risk sentiment, and interest rates. Portfolio optimization. The use of mathematical and statistical tools to choose position sizing that optimizes the expected risk-adjusted return of a portfolio. This is more of an investment technique than a trading technique, but some concepts can carry over for portfolio weighting if holding multiple stocks for a longer period of time. Hedging. The use of instruments to reduce the downside risk of parts of a portfolio without reducing the current position size in those stocks. Stop losses, Also dependent on trading strategy, stop losses reduce the emotional stress when deciding when to take a loss. They also preserve capital and improve consistency. Sticking to playbook setups. Only taking trades that fit within a trading system that has already been backtested over a range of market conditions. Position sizing. Following a consistent rule set for having positions in a way that makes the average downside risk for each position predictable. Scaling. Tends to reduce the magnitude of both winners and losers, but overall makes trades more consistent and can be beneficial for trading psychology. The effect on overall performance should be assessed through backtests. Emotional control. All aspects of systematic trading require an emotional state that allows consistent implementation of that trading system. Diversification. Shown here is a basket of stocks, including Zoom, Enphase, NEO, Spotify, Tesla, Palantir, and Plug. All of which were highly correlated and had large drawdowns from February to June 2021. The purpose of this example is to show how you may think you are diversifying your portfolio, but may actually have high correlation risk. For comparison, the energy ETF, XLE, rose by 26% over the same time period, peaking in June. Hedging. By hedging, you are looking at protecting against downside risk on one of your positions. You could sell the stock, but you may not want to exit the position due to liquidity, tax, or one of many other reasons. However, you could instead use options to hedge a position. The use of options allows more advanced strategies like protecting against a large downside risk without completely eliminating potential continued gains in a stock. Selling calls can be used in scenarios where a high volatility event, such as earnings report, is expected. The options sold will provide some downside protection while providing guaranteed cash flow in the case of a lower than expected move in the stock after the event. Black swan events can affect specific stocks or even the entire market. The COVID-19 crash affected the entire market, so hedges that protected from broad market downside risk were required. These types of events are very difficult to protect against and require a good understanding of both global events and their potential effects on the market. Even more difficult to predict are events that affect a single company or subset of companies. The Archegos blowup occurred when Archegos Capital, a family-run trading office, illegally used massive amounts of leverage to pump up the valuation of a number of stocks. A negative shift in the market occurred that caused the fund to effectively blow up. Shown here is DISCA, a stock which lost almost 50% of its market cap in just weeks when the fund blew up. Events like this are nearly impossible to foresee, and this emphasizes the importance of using stop losses and diversifying the portfolio. Stop losses are orders that automatically trigger the close of a position when the price trades through the stop level. Stop losses are crucial for day trading because it is common for massive unexpected moves in stock prices to occur more quickly than the trader can react and execute a new trade order. In swing trades, the necessity of stop losses is more up to the trader preference and system. This is because the trader usually has time to react and make a judgment call on a rapid movement against their position. For example, it's common for the market makers to run stop rates, which are quick, low-volume pushes of a stock price below a key support level or above a resistance level that is designed to trigger hard stops placed by retail investors. As Mark Douglas famously says, quote, "Because patterns, or edges, show up in every time frame, technical analysis turns the markets into an unending stream of opportunities to enrich oneself, not on a trade-by-trade basis, but rather as a percentage over a series of trades." End quote. Having an edge, or winning strategy, is fundamental to making consistent gains in the market. To create an edge, taking statistics of your trading history is needed. Here are some of the most fundamental components of an edge: the probability of winning, the probability of losing, the average amount received in a winning trade, and the average amount lost in a losing trade. also known as your stop loss or predetermined risk. Using these stats, we can easily calculate the average return per trade over a series of trades. It is important to note again that there will be a random distribution of individual outcomes. So while your average return may be positive in this formula, there's always the possibility of many losing trades in a row. Let's take a look at an example of a winning strategy. As you can see here, this trader has a win rate of 75%. The average risk is $200 per trade, and the average return per winning trade is twice that risk, or $400. Winning $400 75% of the time and losing $200 25% of the time means that this trader has an expected average return of $250. Over a series of 100 trades, following this strategy exactly, this trader should net $25,000. And here's an example of a strategy that will not have as consistent results. This trader has a win rate of 60%, average risk of $200 per trade like our last trader, with an average return of 2/3 of that risk, or about $133. Winning $133 60% of the time and losing $200 40% of the time gives this trader an expected average return of $0. After 100 trades, this trader will be lucky to be break-even. The Kelly criterion for binary outcome bets provides the optimal proportion of an account to bet when the probability of winning is known and the outcome is either a fixed multiple of the bet size or a 100% loss of the bet size. If a strategy has been sufficiently tested to determine the probability, this equation allows for the fastest account growth possible over a large number of bets. The chart here shows the ideal bet size relative to the account size, given the two changing variables B and P over a large range of values. Note that if F equals 0, that indicates a situation where the equation output is less than or equal to 0. This represents unfavorable conditions in which the account will lose money over time. In other words, this chart shows that with a higher win rate, the ideal bet size on each trade increases. It also shows that as the amount won per trade increases, it is ideal to bet more of the account on each trade. When you lose less than 100% of the bet per loss, this form of the Kelly criterion can be used. It's very similar to the previous version, except that it accounts for a fixed proportion of the bet size being lost for each losing trade. Choosing a position size. A more common and conservative way of setting a position size is to aim for limiting the loss to 1 to 2% of the account size, such that when the stop level is hit, that will be the expected drawdown of the account. Now, obviously, a gap down and slippage in the stock price may result in a larger loss, but sizing this way is conservative enough to where a few outlier events will not be very problematic for the trading account. This trade was for SIRI in June 2021. The entry point is long over the symmetric wedge, and the stop level is below the upper trend line. This accounts for a reasonable amount of intraday volatility. To keep our predetermined risk at $100, or 1% of the $10,000 account, we must use this formula using our most ideal entry and exit points to extrapolate the best possible position size for our account. As you can see, our ideal stop level is 21 cents below our entry point. This means if we buy 476 shares and stop out, our drawdown will be about $100. The TradingView long-short position tool allows the computations for position size to be based on dollar amount, account percentage risk, entry level, and stop. It also shows profits at specified price targets. This is a great tool to keep your predetermined risk on each trade. Scaling in and out of positions. It's common for traders to scale into or out of a trade by taking multiple fractional entries to enter a trade and fractionally exiting a trade at different price targets. This can improve the percentage of winning trades over time, and can minimize drawdowns per trade, but it sacrifices some potential home run profits. As an example, if every trade were taken only at the most ideal entry points and profit targets, the number of winning trades would be far less than if trades were scaled into over several potential entry points and scaled out of at different profit targets on the way to the most optimistic profit target. On the other hand, if you keep the entire position size, the average winning trade would be far greater because the entire position size would be held on to the final profit target. Most experienced traders find it far better to scale in and out of trades rather than taking the all or nothing approach. Doubling down on higher conviction trades can be useful, but the maximum position size should still not exceed the predetermined risk allocation for the trade. Averaging down. The concept behind this method of exiting losing trades is to double down at key areas of support, then to exit the trade at the level the stock is likely to bounce up to, usually the previous breakdown area. It is a higher risk and more advanced method because you're adding to your position size when you're already in a losing trade, potentially compounding the loss if you don't get the expected bounce. In serious market drawdowns, where the selling pressure overwhelms the technical areas of support, this can be very dangerous and result in a compounding loss, so this method should be practiced with discretion. In this example, the trader initially buys the stock near trendline support. As you could guess, the trade does not go in their favor. The second entry is at the bounce of the next support, in hopes of getting a retest of the trend line the price action originally came down to. Unfortunately, the stock continues to fall, breaking through trendline support, but bouncing off the next horizontal level of support, providing an area where the trader can double down on the position. The trader then exits near trendline resistance for a near break-even trade. There are important limitations to doubling down on a position to break even on a trade. The graph here shows how the new cost basis is a function of the initial cost basis, C0, the cost basis of the new shares bought, C1, and the amount of shares bought during the doubling down. As we can see, the more shares bought in the second purchase, the closer the cost basis is to the second purchase price. However, the most effective way to reduce the cost basis is to buy at a lower price. I should emphasize that the new cost basis is the break-even price, the minimum price at which you can sell to avoid a loss. A martingale type strategy refuses to accept a loss and blindly doubles the trade size every time a loss would be realized. Shown here is the results of such a strategy for a randomly generated sequence of numbers, where the probability of winning each trade is 50%. There is no directional bias to the price action, and trades are entered at random. Exits are only made at the fixed profit target, or when the account size becomes too low to double down on size again. As can be seen, the curve goes in mostly one direction, with the exception of massive drawdowns. The emotional aspects of trading should not be underestimated. You should keep your trading sizes small until you've experienced bad days and the emotional consequences that come with them. As is true with gambling, it only takes one bad day of trading to blow up an account. Becoming consistently profitable takes practice, experience, and the self-development required to overcome demons, like revenge trading and trading on tilt. Sometimes, the best thing to do is to recognize when you are starting to go on tilt and to have a plan for flattening those positions and walking away. United Traders has many other videos on trading psychology, as well as meditation. Check out those videos to learn even more. The results of poor risk management. This graph and the corresponding table show the required profit percentage on an account value to make up for a drawdown. As can be seen, it's much easier to recover from small losses than large ones. A 50% drawdown requires a 100% gain to recover the losses. The relationship is exponential, demonstrating how much more important it is to preserve capital than it is to have large winners. This concludes our introductory lesson on risk management. I'd like to give a massive shout out to the team responsible for putting this lesson together. The team at United Traders is always looking to improve your skills as a trader. For a continuous wealth of knowledge, join our Discord. Thanks, and we'll see you next time.